Hello, Culture Matters podcast. Boy, am I excited for this episode today to learn. Before we do that, here's a quote just for this episode. The more things people worry about, the better for an investor, because those worries are already instantiated in the overall market. Bill Miller, our guest today, has an opinion on that quote. I know it. We're going to learn from them. They've got a deep understanding around investing, specifically value investing, but not limited to. They've been thinking about stocks, or also known as securities or marketable securities. They've been thinking about business since they probably were young, maybe in their diapers, but I know definitely in the teens, definitely in the prepubescent teens,
I came
they
out the
are
womb.
out the womb. This person has been on the podcast before. They're a regular on the show at this point. If you aren't familiar with them, I beg you to start listening to the show more often. They come from a family of entrepreneurs, but they've got their own flag planted in the sand, building a value investing, if I understand correctly, um, fund or business of money. And I should probably introduce them by now. They actually have a fund, and I should probably say that everything we talk about isn't financial advice, but it is a fun conversation. Hopefully you can have some thoughts from it. But Aleck Arena joins us once again, Arena Securities, to talk all things value investing, Berkshire, and so much more. So thanks for
Yeah,
coming back on the show.
thanks. All good, Jay. I really enjoy it, and I enjoy listening to the podcast too because you guys cover a wide variety of topics. Yeah, it really gets you thinking sometimes, like because they're very different guests. And I was listening. I think he was a mortgage broker, and he was talking about the shore, and it really made sense to me. And because he was from New Jersey, and because people around that area, they all gone on about their shore houses, and oh my god, it clicked something bad. I laughed so hard because I went, oh, like they're trying to tell me what they've got. I don't know. Good to see they're going to the beach. I don't. Congratulations.
That is so funny.
Yeah, yeah. And the one with your mum yesterday, that was really good too. But yeah, definitely it challenges your thinking at times, gives you an insight into a different industry, which is always good because I don't know, constantly want to be getting better and moving forward. And yeah, I feel scared some days when you feel like you're not. But
Uh,
back to the Bill Miller quote. I've jumped here a bit, but I do think that is true, to be honest. It will already be in the price. If people are worried about certain risks, it's probably already in the price. Um, Sometimes you're the first, if you're like me and you're really paranoid, maybe you're the first person to come up with a risk. I can give you one from the other day. So we're really jumping right into it. But a company I followed for probably 5, 6 years, I followed decently closely. It's called Laser Bond. It operates out of New South Wales. It's probably an $80 million market cap. They've got they pretty much do laser bonding, and they're mining services business, but they have their own IP and they add to the wear life of buckets and certain products for big diggers and loaders and all that. So it's probably best that you use their products because you can get a longer wear life if that makes any sense. So they bought out a business in Western Australia, so where I'm from. Well, they bought 40% of a business in Western Australia called Gateway. The share market, they didn't really disclose the share market that well, like what they bought and how much they paid for it. So the share market had um, not the best reaction to it, and they got marked down about 20% in the day, and I was a bit excited because I knew it marked opportunity. I had a Zoom call with the CEO and the CFO a few years back before I am in my current job, and I was just writing for Claude Walker at the time, and I pushed them about Western Australian expansion. We're such a big market. When are you going to come to Western Australia? Because we're the main mining state in Australia. and they were definitely interested in it. They were telling me about like they have kind of this franchise model where they sell their kind of technology and they take a royalty fee out of revenues for it. But you have to sell your technology to someone first, and then how and if they're using it. It all depends on a few things, doesn't it? So they bought this business. I emailed them. I was like, hey, I'm interested to come down and have a site tour when you drop into Perth. A few days later, I went down with management team, the Laser Bond, and the managing director of Gateway. And yeah, it was a really interesting site tour. I got a lot out of it. Usually, I'm very very skeptical, but the net profit before tax was 2.9 million. So they've got it was EPS accretive because laser bonds usually at about 15, like the average securities on about 15 times earnings. So it's cheaper than that because your publicly traded businesses, so public businesses trade on a higher premium than private businesses because public businesses have the liquidity multiple. Like, so you get the premium in there because you're paying for liquidity because you can buy and sell shares. And that's just the thing that's over time, that's just how markets have worked, which incentivizes people to do roll ups, which I don't think are the best business models of all time. But yeah,
Oh, I
that's
want
definitely.
to ask about that. Just to clarify, and market cap is shares outstanding times share price, correct? So at an
Yes,
80,
exactly.
you said
Yeah.
80 million market cap.
Yeah. So it's a small company, but that's where I usually operate because um, you've got, I personally, it's a filter. Some people disagree with it, but I personally only like looking at businesses that are free cash flow positive, and I want them to be very close. I want them to be undervalued from the get go, so I have a bit of a margin of safety, and then I want them to have some kind of IP or competitive advantage. So LaserBond definitely has that. They're in the New South Wales market. They pretty much dominate that market. They're in Victoria and Queensland, and they've done that the last few years, and they've done that really well. I feel like the CEO's conservative. He's copped a bit of flack from his brother over the years, if I'm being honest. So it was a family business from about 50 years, like it was founded about 50 years ago. He owns 10% of the float. So he owns about $18 million worth of shares by memory. And his brother owned about 10% too, but he stepped down and then his brother sold out because he was trying to say that Wayne, the CEO, wasn't pushing the company forward, wasn't trying to they just had disagreements on how hard he was pushing and wanting for growth. Where I don't mind a person that's a bit more conservative because if you're pushing really hard and you're borrowing a lot of money, it's not that hard to blow up a business. I've seen it happen a few times before. So yeah, I don't mind a conservative person like that at all. But back to the M&A. So they bought 40% of the business. They can go to 51% within the next 3 years. Gateway is a up and coming business around Perth. They they just got into this new site. So the risk I saw coming back to this whole point was this new site. It was actually one of my friend's old houses. So I gave him a buzz and was like, mate, who bought it off you? Because I was like, Laser Bonds bought 40% of Gateway. Does that mean they own the land? Who owns the land behind this? Because I doubt they own the land. And the shareholding structure was confusing. So I thought probably Gateway owns the guys that owned Gateway own percentages of land. So straight away, I was a bit scared about them having constant rent increases, but I don't think that will happen. So it's like a risk I've identified that no one else cared about. And then I did a bit more research into it, and I found it was owned by Gateway Property Group, which was a separate entity to the Gateway Proprietary Limited. So I I found a risk there. Probably wasn't in the price, but it probably doesn't matter that much at all. So because you can always, because once LaserBond gets to 51% in the next few years, they can always move sites if they think they're being unreasonable or whatever. But this new facility is better for Gateway, if I'm being honest, because they had their stuff spread across 2 or 3 facilities, and then they'll have to get all the transport, and they'll be managing a few teams of people at all these different facilities. So bringing it to the one site, I think they can do better and bigger and better things in the future. I also think that with LaserBond's technology, they can tap into a whole new market and create a lot of value for themselves and create a lot of value for LaserBond shareholders, and gives LaserBond a way into the Western Australian market, because Gateway has all the contacts. They've got all the industry knowledge and contacts over in Western Australia, and LaserBond has the technology. So I'm
Wow.
usually not positive on acquisitions at all. Usually 33% of the time, it creates no value for shareholders. 33% of the time, shareholders actually end up losing money out of an acquisition. And 33% of the time, it actually works out in the best interest of shareholders.
Wow, really?
Yeah, it's Australia, America. That's what the history is around listed companies. I think we've had a long time to test that track record.
What are some of the reasons why it's 33, that ratio reveals itself in those terms? Like what are some of the reasons why it could go wrong?
I feel incentives is a big reason on why it doesn't create any value for shareholders, because CEOs and management teams are sometimes incentivized to grow earnings, not earnings per share. So if you're incentivized to grow earnings, you can dilute the business, you can dilute shareholders and keep your like push up your earning stream because you've bought a new business. So share price pretty much doesn't go anywhere in that case.
Is that
Um,
because the efficiency? Is that because is that because efficiency could go down masked by growth?
Efficiency could go down, but the point I was trying to get at there is that your your CEO has pretty much come in and gone, we're going to buy this business, and they've gone, it makes X amount of dollars a year, but we're actually going to give out like shares to this company of our business, and their
Oh,
earnings is going to go, your total earnings goes up, your shareholders get diluted, so their value per share goes down. So you've just made earnings higher, but not made earnings per share higher, because earnings per share has gone down because the number of shares has gone up. Like the share count's gone up. That's I
oh,
see
I
that
have a
happen a
question.
fair bit because you have CEOs and management teams that are incentivized. Because if they then grow earnings, they get shares into the business, they get
Oh,
options. So yeah, it's really, Charlie Munger obviously talks about it a lot. Like, show me, show me the incentives, I'll show you the outcome. Yeah, that's going to be true for the next 100 years.
could there be even more dilution of value if the company that's acquired with shares doesn't add?
Yes. Yes.
Can you
And that's
elaborate on
when you
that?
get the negative. That's when you get the 33% negative. Because
Oh,
they're trying to, it's also, it comes back to the CEO's intensification again. Because even if they're on a good wage and they're trying to empire build to increase their wages, if they swing the bat and they miss, nothing really happens to them because they're still on a, in Australia, would say they're still on a pretty good wicket. So, but if they actually hit the ball, their wage goes up and they probably get shares from options. So it's a win-win for them if they miss it. If they lose, it doesn't really matter. So it's back to the incentivization structure.
what are there certain incentives that do work that we could unpack a little bit?
Yeah, you got Saul Patterson and Berkshire Hathaway. Their because their incentive structures are very different and very well thought out. Probably shouldn't have named any companies, but traditionally their incentivization structures work. And I just wanted to be straight up with you, man. So
Sure.
yeah, it's really usually if you keep, I can't. I'm going to offend too many
We
people
shouldn't
saying
go.
the
Yeah,
truth.
okay. Fair enough. Fair enough. I'm
Honestly,
curious. Wait, I have a question about the when you mentioned earlier about when this acquisition really originally took place, price went down 20%, if I heard you correctly.
Yes, because
You
no
saw that
one
as an opportunity?
I did see that as an opportunity. So their earnings went down 15% from the previous half last year, but the first half is always weaker than the second half. And the first half last year was a lot better than it traditionally is. So I was kind of expecting this in a way, and I expect they'll have a stronger second half. And if you add the earnings from Gateway, the new company, because they didn't dilute on this acquisition, Jay, or they did dilute, but they had about LaserBond had about $6 million in cash sitting there. So they paid, I think, $4 million in cash, and they paid $6 million worth of shares. Um, so yeah, I did think it was a good deal based on like your opportunity in the market. The Gateway's kind of getting to scale a bit now, even though they're just the industrial company. Their site and their manufacturing capacity is better than it was. Um, yeah, it'll be very interesting to look at over the next few years. But back to my point, sorry, I keep going all over the shop here. Gateways, so LaserBond has 40% of Gateway's earnings. Gateway last year made 2.9 million after tax. So before tax, it would be around about $2 million, and then 40% of $2 million is around $900,000. So let's say LaserBond's earnings are bad, they're still about 5.5 million after tax if you include the Gateway acquisition, which then puts it on a fair price right now if you think their earnings are going to be good. In a few years, I think their earnings will be materially higher if you take out Gateway. And now we've got a business that's I think is a good business which can add value again. So that's why I was ready to seize the opportunity. Was going to say excited, but I was definitely pretty interested when I saw what happened. And then when I went out to the site tour, and yeah, I could really see how I think it could work.
And what was
But
the price? What was the earning per share that it was trading at?
the earnings per share was, I would have to go look, and it would be wrong now because so their forward earnings per share, no, that doesn't really matter to be honest. Their earnings per share after the hit is about 17 times earnings. But then if you chuck in the Gateway acquisition, it would be about 14, which is
Mm.
fair, I think, is fair value. And then I've not included that the company is growing. What's fair value for a business that's not growing? So, and then you've got the option of Gateway's earnings growing in the future, and you've got the option of LaserBond's earnings growing in the future, which I think they will. Um, the analysts have their earnings to be about $10 million within the next 2 years, and that doesn't include the Gateway acquisition. So we think their earnings will double, not include the Gateway acquisition. If that happens or not, who knows? All the sell side information, so all the information from analysts is usually already in the price. So that's why I've gone out to the site. No one else has gone
Wow.
out. There was me and one other broker. So we're the only two people that have actually seen the site in person, met the
Really?
other managing director. Because for the big guys, no one really cares about $80 million company. It's not really going to move the dial for much. You actually, if you've got $1 billion under management, if you invest a few percent, you've already breached your 15% shareholding. Like, do you have that rule in America?
Oh, I think I don't know what the
So
percentage is.
in Australia, I'm not 100% sure of the percentage, but I think it's 14.99%. So if you go over 15%, you have to approach the board for approval to own more of the stock. So
I think it's even lower in the US. I don't hold me to that. I thought it was like nine or
yeah,
10.
so like a few $1 million worth, you would own a fair percentage of laser bond, and then they probably wouldn't approve it from a board level. So it's not really worth your time,
And
to be honest.
what's the reason? How does that impact the culture potentially if someone outside comes and
If
gets a
someone
lot of shares? Could that create hostility or um
it Yeah, it does create it does create a hostile share, like a hostile shareholder and a hostile takeover sometimes. Because sometimes people want the business. Um,
Like, why would the
it's
board have to kind of make a decision?
because sometimes you don't want a person from the outside owning a huge percentage because they might be trying to do a hostile takeover and get control of your company because they think it's undervalued or they want to kick you out of position. You kind of loop into activist investing here. Um, and I think the best activist investors are probably Carl Icahn and Bill Ackman, which famously don't really get along that well. So if you haven't watched, I can't remember what it is, but there's a really good documentary around Herbalife, an American company. And I remember when I first when I was getting into investing, um, I don't like to say it, but I probably was a bit of a Bill Ackman fan as a
You
kid,
were?
and I was as a kid, and it was quite intriguing that Carl Icahn came out of nowhere. I remember just being like, I just remember being like a 16-year-old, and I was on YouTube, and I could see this CNBC interview of these two hedge fund managers going back and forth with each other. And I'm like, man, what is going on here? And I'm like, so it took me a while to work out what was actually going on. And I was like, so Blackman short the stock. His thesis is probably correct. I
Yes,
don't
yes.
know. I don't know about this Carl Icahn bloke, but he's just like they both sounded so whiny on the call on CNBC. And then I remember in the background all the stockbrokers on the floor of the New York Stock Exchange were going making oohs and ahs as if it was a high school argument of like who was winning this thing. And it was hilarious some of the names they were calling each other. Very unprofessional, but
Yeah,
pretty
I
much
wish
Carl
I could
Icahn.
play it for the. I don't know if it would work on the podcast, but I wish I could play it right now. For if anyone
Carl
hasn't
Icahn,
seen that on YouTube, you gotta type in. I think you would type in like Carl Icahn and Bill Ackman
I think he'll come up straight away. If you
argument.
type in Carl
Yeah,
Icahn, I think it comes up with Carl Icahn versus Bill Ackman,
yeah.
as if they played some game of tennis, which in future years apparently they did. Um, yeah, so pretty much Carl Icahn bought the stock to try to short squeeze Bill Ackman, and yeah, because Bill Ackman pretty much thought it was a pyramid scheme. I'm pretty sure. I
Yep.
can't really remember the
Yeah,
case.
and they ended up paying a huge fine to the government.
Yeah, but Carl Icahn kind of ended up getting away with it, and Bill Ackman kind of because he announced the short publicly, which is another thing. Is if I'm not interested in short selling at all because the potential upside is capped because a company can go to zero. It can also go a lot higher. So if you think about the risk reward from that point of view, I don't find it very interesting. Like I used to find it interesting when I was younger. Um, Probably helps with managing risk.
Mm,
Like some people
why?
can argue because if you're in a hot market, you can short the very hot like the hot stuff if that makes any sense. So you could go if you weren't a believer in crypto, you could go short some cryptos. You could maybe like in this market, people would be shorting Nvidia. But see, I'm not a genius. I know that I don't know how to value Nvidia. But people will do it and try to do it, and the video can just go up infinite. Like they can, the stock can just keep going up. So if you're on the wrong side of that, you got to pay your short premium, and then you've loaned out the stock pretty much. So then you've got to buy it back at a higher price. So when you short sell, you've bought the stock off someone. You've then sold their stock and then in a few years' time, when the contract's over, you have to buy stock back on market and give their shares back. So if the share price goes up, you've lost that money, plus you have to pay them a premium for actually shorting the shares. So it's a complicated thing.
Like if
And
you buy it at 50 and then because you think it's going to go down to 10, there'd be a 40
yeah,
spread. But if it goes up to 90, then you lose 40.
yeah, and you also have to pay the premium. So you have to pay them in form of interest for having their shares.
Wow.
So it's not an easy game. There's So I've actually met John Hempton. So in the I feel like somehow we're talking about Bill Ackman today, and I don't know that much about Bill Ackman. But in Valiant Pharmaceuticals, when Bill Ackman owned that stock, he was actually on the Netflix documentary. So John Hempton actually worked for Kerr Nielsen, and he's got a short book of about like he's got a sorry. When we talk about a book, we're talking about a portfolio.
Oh,
So his portfolio, he's got about 600 shorts in there. And
whoa.
if you speak to him about shorting, it's very interesting because he would talk about are you better off shorting a complete fraud or are you better off shorting an overvalued business? And he kind of feels that you're better off
Matter, I
shorting
think.
an overvalued business, not
Yeah.
a complete fraud, because the fraud can just keep making up the numbers. So you're not competing against something fair. When you're competing
And they
against
create
overvalued.
the crowd effect.
Yeah. So like he's talked about like having gold
Wow.
mines across the world and then they're saying they're making money, but he knows they're not making money and all this stuff. He's a very unique person to speak to.
Wow.
Yeah, if you watch the documentary, you'll probably work that one out. But yeah, I couldn't do what he does, and it's a hard game, man.
So you would say right now your book is focused on small.
Long only. Yeah, yeah. So
Can
I
you
don't like.
describe that for the audience so they can conceptualize it?
So pretty much, I do hold medium to large caps when I think companies are undervalued. So the larger caps in Australia that I would own, which they'll be mid caps, would be Stanmore, which is a met coal company that produces PCI met coal. And then I own Brickworks, which do you need a rundown on Brickworks, mate?
No, no, isn't Brickworks one of the holdings of that?
Sol Patterson,
I
yeah.
knew it.
But
Okay, yeah.
Brickworks owns shares in Sol Patterson. So Brickworks is a bit of a weird one. So pretty much Brickworks owns 26% of Sol Patterson. Sol
Wow.
Patterson's roughly worth $12 billion. So their stake in Sol Patterson's worth about $3 billion. Brickworks market cap is about 4 billion from memory. Um, but then they have about $3.7 billion worth of real estate in their portfolio.
Wow.
I work out how to zoom in on you, Jay, because I've lost you. So yeah, it's about $3.7 billion worth of real estate in the portfolio. That's industrial real estate, and
Wow.
I've sorry, yeah, $3.7 billion of industrial real estate, and how that came about was Rob Milner, the chairman, was the chairman, which is also he's not the co-founder of Sol Patterson, but he's third generation of Sol Patterson. So he was speaking to Lindsay and they'd sold a property and pretty much they decided with the profits they were going to go buy an industrial block. And then with the yearly rent from the industrial block, they decided that they would invest 80% of the rent back into industrial properties and they would pay out 20% in a dividend because in Australia we do have franking credits. So they've kind of been rolling up the property portfolio, if that makes any sense. And they owned lots of land around Australia. So they would own a brick plant. The brick plant would be out just outside of your kind of city area. Your city would expand. 50 years later, they would subdivide the land into residential housing. And then you would sell off the land for a much higher price than you bought it on because you could sell it for like 50 or 100 residential blocks in Australia. And it was then the Milners, I don't want to make them sound too good, but they pretty much a low operating cost is their kind of whole motto. So they bought the brick plants where they were because there was brick sand already on the site. So usually you have to not import, but you have to try to get your brick sand to your site. So they thought if we buy a brick plant and the sand's already there, we cut that cost completely out. Because the return
Wow.
on capital in bricks is terrible, especially at the moment. It's about 1%. But it's all about, with Brickworks, it's all about the property portfolio and their future developments and the land they hold. But no one factors in the land they hold um, in the price, really. Like there'll be certain blocks that they could subdivide, and there would be a massive value creation for shareholders that no one really has thought about yet. And then you've got the Sol Patterson shares, which are pretty much worth as much as the whole Brickworks itself. So my valuation would be probably about 30-40% higher than the current price. And Sol Patterson shares are also growing too, because Sol Patterson's like a very diversified company. They own I think 40% of New Hope off the top of my head, which is two thermal coal mines. One's in New South Wales and one's in Queensland. New Hope also owns a petroleum asset. They also own 15 or 20% of a met coal mine in Queensland. And then Sol Patterson owns about $2.5 billion worth of shares in Australia. They've got a private equity portfolio which is worth about $1 billion. And yeah, there would be various RL holdings, and it would it's kind of a bit like Berkshire, but no insurance business. There's a coal mine instead of an insurance business, and that's where you get this free cash from. Like you get all this free cash that's produced, and then they'll go invest that. But where Berkshire's a lot more to do with Geico.
Now, the coal mine that produces, is that that's a profitable business then? Generally, that industry.
Yeah. Well, because of the Milners, they have the second lowest operating. The operating cost of the mine is the second lowest in Australia. The bigger mine in New South Wales, so it usually makes money across most of the cycle. There's times where it will lose money, but it won't lose too much because its cost level's really, really low, and everyone else that produces coal, their cost level's much higher.
So let me get this straight. What are some of the factors why you think that culture was able to have the cost so low? Is that an industry thing, or did they have some type of
Definitely not an
let's say,
industry thing. It's because the infrastructure built around their mine is it's very good. It's also about the geography of where the mine's located and how it was built. Um, it's about some of the Sol Patterson culture that's got them there, in my opinion. Because if you look back at business over the last 120 years, it's their culture to do what they've done in the coal industry, in the brick industry. Always have the lowest operating cost because you'll survive your way through the cycle. You'll have opportunities to pick up competitors, and Rob goes into staffing a lot about it. He'll go like, if you can't afford to pay your staff are then going to leave, and then when the industry turns, then you're trying to get all these staff, and then who knows how to operate the machines, who knows how to do the work, so because you can build your staff base and you don't need to constantly hire a lot of people, lay a lot of people off, it works a lot better.
it sounds as if they're able to get an exponential return on their people by developing tenure, relationships with their employees.
Yeah, I think I think I'll leave most of the Sol Patterson stuff up to Rob Milner because he can probably do it a lot better than me. So, but you can watch. He's done a few interviews, so if anyone's interested, just search up on YouTube Rob Milner Sol Patterson, and he probably explains Sol Patterson business better than I can. Yeah, he can. I'm just a novice compared to him because he's there on the operation. He's there every day.
What about what's a small cap?
Different to what it is in America. So in Australia, a small cap is a company under $200 million market cap. That's defined what it is by a professional. Do I believe that? No. In America, It's a company that's under a $500 million market cap, or $1 billion. I can't even remember because you've got a much bigger market than us. So in Australia, you're a medium cap if you're over a $200 million market cap. Pretty much, you're starting to get to the large scale.
Wow.
So yeah, it's
What do you
different.
consider it then? How do you look at the small cap?
I don't really care if it's under a certain market cap or over a certain market cap. I find that I just see a lot of value in companies that are under $100 million market cap. And when you get over a certain market cap level, you get a like liquidity, you get the average liquidity premium. So their earnings, a small business's earnings are likely to grow faster than a really big business. And then you get a premium from the share market on the way up. And also there might be a bit of quality around the business. So they probably operate in a certain niche and maybe they do the niche really well and they can scale that niche. Um, so yeah, that's why I just see lots of opportunities in small caps. But as I said, I do own Brickworks and I do own Stanmore, and yeah, it would maybe I'm very interested in coal J because there's a bit of coal tied up in both. Like there's coal tied up in both of those.
Hmm.
Uh, it's I don't think it's a chance that Monish Babrai also liked coal and I liked coal. I think we're looking at the same. We're trying to like we think there's value there because it produces a lot of free cash.
Um, the, you mentioned that you went to go physically see land or meet with people. You had what
Yeah,
why?
yes.
What's the value in investing that extra time, would you say?
I don't. I'm different. So my some fund managers believe in going to speak to management teams and doing that. I don't love the idea of speaking to management teams, especially on a one-to-one basis, because they're just going to tell you what you want to hear. In my opinion, I went to go see the site and check out the infrastructure and work out a few things on the ground level, and work out a few niches. I also did a bit of legwork around Perth, the industrial area of where I'm from, and called up a few people and said, have you used Gateway's products, the company that LaserBond bought out? Are they
Mm.
any good? What's the reputation like? What do you know about the managing director? I bumped into someone that actually worked for him and I said, like, what do you think about your boss? Like, what's he done in the workplace? And he said, oh, to me, he's always been like a good bloke. He knows me by my first name. He's got 120 employees. He's
Wow.
always willing to lend a hand, and he spoke highly of him. So I didn't mind that. But yeah, it was about the groundwork and seeing the site and seeing what it could be in the future. And to me, it wasn't too much about speaking to the LazyBond CEO, but I have done a few meetings with company CEOs in the last few weeks. One was to just get a better understanding of the business and where they were wanting to go in the future. For understanding, it probably works well because you'll understand smaller parts about their niche better. But then they can also, that's why I don't like speaking to management teams because they can hide stuff from you too. They're not going to be like, most people aren't going to be like, oh, I think I've got a problem over here. Because why would you, if I was going to invest in Culture Matters, maybe you're different. I don't know. Like, but usually, Jay, you would go, I'm the best. I'm the best at what I do in America. um,
I don't think I'm
This
that
is
good,
me.
frankly.
I, I do this differently to everyone else. No one else does this. Um, this is why culture matters, and this is why no one understands it. Well, maybe you're actually, I don't know. I've seen your kind of mottos, and I think maybe you're actually right there. But yeah, you would tell everyone that you're the best. You're the best in America. No one else would come close to you. You gotta, your future prospects look amazing. Sometimes it's probably
Hmm.
because that's where they want to take the business and they actually believe it themselves. And because I don't think there's much,
Yeah.
I don't think a management team lying if you're at a semi-large scale, is going to do much for the company. So it's not going to, if a fund manager comes along and puts in $1 million and you're a $200 million market cap, it's probably not even, if they stagger it in, it's probably not even going to move the share price at all. So yeah, sometimes it's just what they believe and what they believe moving forward. So yeah, I take everything with a massive grain of salt and see what I actually, and think about what I think is actually going to happen. So I called up a friend and about the Gateway Laser Bond merger, and I said, mate, I'm actually quite positive. And he was a bit shocked by it and was like, what do you mean? Like, why are you happy? Why are you positive? You're always grumpy. And I was like, oh, because I think they could integrate here and here. And he's like, oh, Jesus, maybe I've rubbed off on you a bit too much. Because he's mainly positive usually.
Wow.
And yeah, so I'm usually the person that's negative, doesn't want to speak to management. It's weird. Yeah, I don't know. People are usually a bit taken back by how I speak to management. I had a friend from high school one time come out to do a site tour with me. And it was going great. I was learning about their IP or their product, and I was learning how it was different. And their stuff is genuinely different in this business, and it's generally they've got a real good quality product, but they just don't have the scale. And the CEO came up to me and started speaking to me, and I just was like, I asked him for his card and just left it at that pretty much. He wanted to speak to me more, and I wanted to go speak to his employee because his employee was going to tell me more about the business and give me a better insight. And his employee was less filtered too.
Mm.
So I just wanted to speak to the employee, just want to know more about the product. And the employee was blatantly honest on where he thought they could go wrong or where he thought it didn't, where the CEO was completely different. And yeah, that's why I usually just try to nip around and speak to the employees instead of speaking to the corporate leaders of the company. Prefer the guys in I prefer the guys in high vis than the guys in suits. That's just me.
And part of that is make sure I follow your thinking. The incentive of the employee is maybe less
Yeah, they're
counter.
not trying to. The employees aren't really trying to promote the business. They're just trying to do their job. They're just there driving a forklift, fixing up a car. Just they yeah the CEO is trying to tell everyone why their company is great. They're trying to represent the company really well, and that's in their job description. There's reasons for that, and I'm okay with that. But I don't waste my. It's not wasting your time speaking to them, but it's more insightful for me personally speaking to an
Sure.
employee, and that's if you're a. So that works well if you're a small industrial company. Um, but if you're a technology company, you're not doing a site tour, so you have to speak to management if you want to speak to anyone at the company.
Um, Financials or reports.
Yeah.
How have how is it different today versus in the beginning of your career and how you approach understanding the company's financials? Is it different? Is it
That's a
easier?
hard question.
Is it harder?
It's kind of it's kind of just easier today because when I first started, you I'd read reports, but you kind of when you're following a group of companies and you've followed them for a few years, you kind of understand a lot more about the business and you understand their past results. So it gives you a better insight into the future results, if that makes any sense, and where and how they're building. You're also, if you're looking at a certain company's accounts, a company might do their accounts slightly different to a different company. So it'll make a lot more sense to you because you'll go, this company writes down X and Y. This company's profits are a bit fudged around here. And so it does make it's probably easier as you've been doing it for longer. But it's not too different. The reports haven't changed too much. They're the same length on average. They still kind of management teams kind of say the similar stuff in the reports. And yeah, it's pretty similar from that kind of perspective, but it's just better because it kind of flows better in your mind. Because I'll remember about a result back from 2019, 2018, 2020, and I'll be like, okay, this happened there, this makes sense. Or I'll be like, sorry, this result doesn't make sense whatsoever. What is going on here? And then the alarm bells can start ringing. So yeah, that's kind of. And you also can seize opportunity faster if you know a company quite well, and you know they generally something's gone wrong here, because you've read their accounts, you've read through it, you know the management team. You can go, okay, yeah, I think this is just going to be a one-off. It's very rare that I'll do that though.
What about when you're building the book? So you're starting with one company. How do you get to 10? Is that
You don't.
you don't?
You try not to force it at all.
Okay.
I was actually thinking about this yesterday. And I feel like I do force stuff a bit too much in investing. Just slightly. Um, I feel like investing's such a hard thing because you want to be looking for opportunities, but you don't want to be too excessive. You want to be looking for heaps of opportunities, but you don't want to be looking. If you look too much, you're likely to find something that you want to find it because you've been looking. If you understand, it's
Wow.
like if you're paid to do a certain thing, and I enjoy investing and I enjoy looking at opportunities, but the best ones come to you. You don't really usually go to them. That's the best opportunities usually. So if you're chasing opportunities and you're chasing them hard, you're likely to end up in the wrong place. I don't know, it's really weird. There's like a fine line, and I'll speak to great investors about it, and they tend to agree with me. And there's a fine line between overstepping and not actually doing your job, and then just about doing it. And I'm probably just a tiny bit over the doing too much, because I find looking at companies and looking for their financials and looking at new products and all this stuff, I find it more interesting than writing reports. Probably like if I'm sick, I'm probably going to be looking at annual reports. It's really weird. Like if I've got like a spare, if I've like done what I need to do on a Saturday, done my weights, gone to a custom sports game, and I got nothing on and my girlfriend's out, I'm probably going to be looking at reports. Some people want to be watching TV, but as long as the Brisbane Lions aren't playing, which is my favourite sports team, I'm probably going to be looking at reports. But it's just it's like what I want to do. I don't know, it doesn't make much sense, but it's like, yeah, I want to do this because I find it very interesting. But then that can be at a detriment because then sometimes you'll find something that's completely wrong, and there's a better opportunity right in front of you. So yeah,
Hmm.
it's hard. It's a hard juggling act.
How do you how do you not do anything?
What does
You know,
Charlie
like,
Munger
or
say?
like doing what is it? Charlie Munger said,
When you find an opportunity, sit on your hands.
yeah, and like,
I think he's chucked a swear word in there too, but yeah, sit on your ass pretty much, and just let it compound and let it work for you. Um, yeah, lots of Charlie Munger things say. Like he's just an absolute gem.
like
Uh,
how do we hold our winners and sell our losers?
well,
Seems so
sometimes selling your
counterintuitive.
yeah, definitely. Sometimes selling your losers is wrong. I understand what great investors mean by that because if you're selling your losers as a more novice investor, you're probably there is probably something wrong that you can't see, and there's something that keeps going wrong. and the winners are executing. So that makes sense if you think about it like that. But sometimes there'll be a half that's like if you've bought a share 6 months later, they have a bad half, but the thesis is still intact. You shouldn't sell. Like it depends what's actually happened, but most of the time you shouldn't sell that stock. Um, Thesis creep is also such a hard thing because you'll buy a stock, it'll go down, and then your thesis is probably broken, but you'll be like, it's cheap, but it's cheap though. So you'll try to still hold it because you're trying to patch over your mistake, and it's kind of a psychological thing. So the
Mm.
great investors cut their ties very, very fast. If they feel thesis creeps coming in, they'll know, yeah, my thesis is broken. I don't care. I'm getting out. Where the
Wow.
more novice investors will be like, they'll be down 95%, and they probably, when it was down 40%, the thesis was broken, but they were like, it's cheap. But the thesis was broken, so it really kept moving down. But like I was thinking about, so one of my winners has been Findy. In the last 6 to 8 months, it's actually nearly been a 10 bagger for me. So it's the
Wow.
Indian payment system. I bought it at 40 cents, and this morning it was about $3 a share. Um, with compounding, I've been through, like I was going to say all the lectures, but you go through all the great investors stuff and they talk about compounding, don't stand in the way of compounding. And when you find a good idea, like don't sell it. And like with Findy, if I'd taken a profit at like $1.20, it would have been the wrong move by such a far length that you're
Yep.
just better to sit there and hold. Even when you come, like, it's so hard to explain, but when something's gone wrong, you're better off just sit there, ride it out, and hold because had stocks going up, your purchase price is still only 40 cents. So it's your, I can't explain it very well at all, but
I follow them.
your purchase price is still, so for me, my purchase price is 40 cents. Every time it goes up 40 cents, it doubles. And I know everyone can understand the concept. When you physically see the concept, it's a completely different thing because you understand how powerful that is for your portfolio. Because you can have a few positions that are heading the opposite direction. And because they're executing really, really well, it's best just to leave it. As long as you still think the thesis is intact and it's not extremely overvalued, it's best just to leave it and sit there for the ride and don't trim it just because it's going well.
Wow.
So yeah, it's investing is such a hard thing.
I wrote this down like I love investing because it's a game of contradictions. Just seems like there's so many contradictory sage. There's levels of contradictions, but there's
There's
so
kind of
many
your base rules.
contradictions.
Yeah, there's like your base rules, and then there is contradictions kind of across it. That is such a complex thing that not one size fits all in investing. You
It
kind
reminds
of,
me of philosophy a lot, which I like philosophy because the if you study all the investors, it reminds me of studying the different philosophers. They all have their view of the world,
yeah,
and they're fun to go down the rabbit hole of why this philosopher thinks this or
but that's probably
this
because something's
philosopher.
happened to them too.
Go
There's a
ahead.
few things that have happened to them that have shaped them. Um, with
Yeah,
me, my kind of more of my playbook, honestly, is in smaller industrial businesses because I find them easy to understand and they've got kind of a niche with their product. So that's my playbook, and from there it alternates. So a mate sent me a company the other day that was a technology company, and it looked promising, but I couldn't really understand the price, and I could be wrong because it looks like it's in an inflection point and it will scale quite fast. But I still don't understand the inner workings of the business that great. I understand inner workings of a radiator business, of a brick plant, of braking business, of a, a gyro stabilizer business, a propeller business. They're like, I understand what happens, why it happens, how profit margins get hit, um, who they're supplying, like key customers and all that. It's yeah. Usually they have like it depends who they have as a client and if they have diversified customers, if that makes any sense. Because you come across key client risk. So if one client leaves and he's 80% of profit, the business isn't in a good place.
Oh, that you bring up a good point because I think startup businesses, it's a natural path for that 80-20 rule for 80% of the revenue to come from 20% of the clients. However, there's like this gulf that I've witnessed, in the private sector where it takes systems, processes, and essentially uh, some type of like it's some type of leap to go from that first, maybe that first client to that second to that third to that fourth from a sales and marketing and brand perspective. Meaning a company it'll be a natural thing that 80% of the revenues will come from 20% of the clients, especially in the beginning if it survives. However, it has to at some point diversify its clients like you're talking about. And to do
Yeah.
that, it has to have management in place to be able to do that. It has to have goodwill developed between its shareholders, like the clients, the employees.
Goodwill's underrated from a like product perspective. If your product stands up in the real world and keeps standing up and you deliver your product on time, people understand like you become a trusted
Yeah.
brand in the community, especially with industrial stuff, and people are more likely to go back to you and rave about your products. And goodwill's underrated.
It's fun. Yeah, I think it is, especially in the business world. All the books and about selling and marketing and things. It's like if the candy doesn't taste good, I think of like C's candies. If the candy doesn't taste good, you're laughing like,
What does Warren say? Warren says, if you bought this for your
oh,
girlfriend for Valentine's Day. 30 years later, C's Candies, the price of it's gone up like 250%. Are you gonna go buy like a $5 box of candy, or are you gonna buy a $40 box of candy because it's sentimental and that's what you bought her, and she's probably gonna hit you for being a tight ass pretty much.
yeah, that's a great point. Like, do you
So
think
that's kind of
we
developed C's Candies
undermine
moat.
we
It's
undermine the
developed like C's Candies. It's moats developed over the years because everyone knows and loves their product.
What
And
about
yeah,
what about Miss B, right? Sell cheap, tell the truth. I'm missing one. There's three rules. Sell cheap, tell the truth. Mrs.
I've
B,
actually never heard
Nebraska
of this.
Furniture Mart. Yeah. She said, tell the truth, sell cheap. And there's one more thing. Remember the woman that founded the Nebraska Furniture Mart, the Russian immigrant that we're going to
I
go
remember
see?
I literally worked out who you're talking about straight away when you said sell cheap and sell the truth.
Yeah,
I
Mrs.
can't
B.
remember the third one.
I don't know the
Yeah, yeah.
third.
Mate, what an amazing lady she was. Started a business at what, like 75, and then Warren bought it, and then she started another business when she was 90. And
Yeah.
she he signed her up the second time and said, "No more business starting for you, all right? And you can't start up the same business practically again." But yeah,
Yeah,
that
like
was some amazing story.
what do you think it was that led them to pay? So they bought her 100%, right? They bought her
Yeah,
entire company, and then
yeah.
she
They
stayed.
put
Why would she, or her kids stayed on, I think.
no. She stayed on the second time, and I think her family stayed on too. Because you're attached to the business, and the business is your baby. I find it with co-founders quite a bit. Um, and yeah, there's kind of like a sentimental value to themselves, and sometimes they'll have. It depends how you comes back to incentives again. It depends who bought it and how they incentivize the old co-founder. Um, and that was even a big thing with the Gateway and Laser Bond deal because they kind of don't want to be fully bought out in the future. Gateway doesn't want to be fully bought out by Laser Bond because they still want to be incentivized on what they produce from their business. They don't want to be incentivized on what the Victorian, New South Wales, and Queensland companies produce. They're very, not even that, they just want to feel like they're still running their own business. And if they stuff up, they have consequences. And if they do well, they can reap the rewards.
Hmm. How would Buffett come up with the compensation? Didn't he come up with compensation for everyone?
That's what he's freaky about. That's like that's
Seems,
why he doesn't
yes,
make any sense.
seems like a lot of work to come up with a compensation for how many owners could that be? Is it 70 or more?
Yeah, that guy's that's the brilliance of Berkshire Hathaway that he got them to all buy into like one. He got all these people on individual teams to buy into the bigger picture and can like
Unbelievable.
kind of all manage their egos because there's a lot of ego involved in that.
Well, I'll just my 2 cents on it is that I don't think it occurs without him being an active. He's an active manager. Dude, every because ego puts ego in check. So he's ironically active when he's passive, meaning he's always working.
Yeah,
They know he's always working, but it's a
I was gonna say
decentralized system.
he's passive, but he's active. Like you kind of hit the nail on the head. He's
He's in
passive,
his
but
lane.
he's there, but he's not in there. He's not physically in there on a day to day, but he's like everyone knows where he is. He's in
Yeah,
Omaha.
like it's the ultimate leadership, right? People do what people say. Like they trust that he's working harder than them.
Yeah,
That like inspires them. But I think I'm curious what you think about this. I think they were so meticulous about who they partnered with, meaning if they're going to write that check to Miss B, they believe that she's driving from a place that's deeper than money. So you're gonna handle all the financial affairs, right? Basically, they'll never have to worry about money again, and they
yeah.
can, and that's all going to be handled for them, right? Like they're not going to have to think about it. But they're going to work anyway. They're not going to go do drugs or drink or be on an island. Like they're
That's rare.
betting,
And the
right?
deals that have gone wrong, the things that you just said have happened
Which
because
part?
people do change. Like people like will go off, they'll get a bunch of money and they'll go off the rails, and I can kind
Yeah,
of even understand that. That's why
I
what
think that's
makes
a
good.
values thing.
Yeah, that's why I listened to a few like podcast billionaires did recently, and a lot of them say it's actually you can solve it's best to solve problems with capitalism. They used to think non-for-profits would work, but profit businesses actually work better than non-for-profits. And again, it comes back to the incentive structure. So if you can do it and make a profit, probably works better than non-for-profits. But there is definitely a place for non-for-profits. Don't get me wrong. Um, but yeah, some of the examples they gave, what makes a lot of sense.
I'm trying to figure. I want your thoughts on this. You know, how long is it going to take me to actually understand everything that's a part of Berkshire? Like, how many years do we
Like
have?
every subsidiary that's part of Berkshire.
Yeah, because I feel as though I've been studying this company for like 3 years heavily, and I
Yeah,
still couldn't tell you all the idiosyncrasies because it's as if there's this holding company, then it has, and that, uh, like there's that office in Omaha, and then there's all these companies that it owns wholly private,
yeah.
right? And then there's a portfolio of marketable securities. But then those private companies, they own companies that own companies that own companies. Like it's just like it's like a solar system or something, like a galaxy would be better. It like how
It actually kind of is. It's like, yeah, it's like a galaxy. You have like
they've
Earth
created
and
their own universe, dude, their own
yeah, yeah.
index. It's like it's its own index or something. I don't know if I'm using that word correctly, but it's
Um,
its own economy essentially.
I don't know every subsidiary that Berkshire owns. I would only know the main couple of ones that most other people know, plus the big ones and like the big companies they own privately. And I would know I would know every stock in their share portfolio.
I think it should be a college curriculum. Maybe it is somewhere of,
It would
or
take
maybe it will be in
longer
50
than four
years.
years to finish.
So like one of my goals is to have like, I don't know, maybe a room in the house that has like a diagram on all the walls that you could it has all the subsidiaries. I would love to and just to be able to see it. You know what I'm saying? To be able to see the
Yeah,
whole thing and kind of be absorbed in it and like try to figure out. And then you know what I'm saying? All right, what's going on here? And then
the
Buffett said recently that Munger, he said that beautiful. Did you read the new shareholder letter?
yeah, yeah.
What did you say about him? It was like this beautiful thing. Like he was
I
really the
think no, I won't say this. I'll just keep their stuff under wraps. But yeah, I must comment about something else then. But back to I feel like Berkshire's something that most people that are interested in business should study, but not. I don't think you need to work out every single thing that they own because at the end of the day, it's just a bunch of businesses, and it's more how it's managed and how it's run. It's not that you need to know the random shoe store they own in Texas or like that's not something that you need to know. I don't feel it probably doesn't add as much value as knowing the kind of basic principles, kind of the few inner workings of it, and the man behind, the people behind it. To me, that's more important. And yeah, I was just thinking about what else is going on in reporting season that was quite interesting in Australia. We could go back to Brickworks. So Brickworks had their half yearly results yesterday, and they announced a $50 million loss because their industrial property portfolio went down in Australia because their cap rates went up. Rents went up too, which is always a good sign. But because interest rates went up, the portfolio went down a bit. But they actually made money, like with cash flow, they actually made money. So that's the kind of weird thing. The headline result was a $50 million loss. They sold a property to fund some more properties around like in their portfolio. But their debt level would only be at like 18% of their property portfolio, which is really
whoa.
nothing.
Wow,
Um,
that's a freaking great.
I was they're going to do this big industrial development. So at the moment they've got $140 million in Rent Australia is what they annually bring in. And they're going to do this bigger industrial development and they're expecting a yield of about $200 million a year from that development. So in total, they're expecting $340 million a year in yield. So it puts their property portfolio on about a 10% yield, which is fair. And then yeah, I was blown away by that. I was like, that's if you think about that, that's a lot of money.
How much did the stock percentage go down when that headline went out?
Look, so with Brickworks, because
Or did it not go down at all?
it went down, but why it goes down every time it reports. And why it does is because no one understands it. So the quant funds, so they sit there
Oh,
and they look at quantitative numbers and all that. And to them, it's a building construction company. To them, it's a company that makes bricks. To me, it's a holding company that holds shares that are worth money and it holds property. And there's a random business in there that just kind of turns the wheel and makes them a bit of money. And they'll see headlines of they're not going to make much money out of bricks within the next 6 months. The quant funds will get very scared. They'll look at reported earnings. They don't look at the property values went up last half by $400 million. Now they're down by $100 million. They'll just be like, it's really just weird at the end of the day. So they'll look at more of the headline stuff and look at the outlook statement about the brick industry because it's lumped into construction, and they'll go, a construction business. What's a construction business in Australia? Boral. They'll go, Boral trades on 15 times earnings. Brickworks should also trade on 15 times earnings. This stock should go down 50%. So then And then the following few days, it kind of gets corrected. But yeah, it's usually I bought some Brickwork shares yesterday because I was waiting for the quant funds to sell it off, and yeah,
Wow.
I was happy with my purchase.
It seems like the prices would always fluctuate because everyone's playing different sub
Game.
games within the overall game. It's like everyone has different rules they're following, whether they're conscious of them or not. It's like we're all playing different games within a larger game. So of course there's a perceivably irrational aspect to the market because if we're playing different games, like maybe some I don't know, just that's something that comes to mind. Is like people are playing from different rule books and
I'm playing value investing. They're playing purely off the numbers, but then what a value investor is, don't even think a value investor could tell you. So you've got,
really.
yeah, it's like you've got your very traditional value investors, and then you've got your Charlie Munger type value investors, and then you've got people that are in between. Yeah, it's I don't think value investing is such a broad thing that it's not like one size fits all. It's like I'm a value investor, and then
I
what does that
wonder if
actually mean?
there's like the new, I wonder what that next, um, what's that book called by Ben Graham? The, the Ben
It's
Graham,
not the
he has two of them.
uh,
What was that book?
securities analysis or the intelligent investor or
Okay, there you
Graham
go.
Buffett.
The intelligent investor. I think that maybe in this next generation, there'll be a new intelligent investor,
Is that Seth
this
Klarman's
new
book
world.
though? Is that the
I,
margin of safety? Because everyone thinks Buffett thinks he's the best investor in kind of like more of like the
think so.
generation that's about 50 years old. Probably, I don't, I feel like security analysis is the Bible. We'll just add to that. It's actually like, because it's been edited from all these different eras. So you would expect the greatest investors to just go and add to it if they're generous enough with their time.
Huh.
I feel like people will add to securities analysis. Um, if you haven't read it, it is like the Bible. Um, it keeps growing. It's really, really big and takes you back through all these investing eras. And yeah, it's quite interesting for
Hmm.
me. The average person, if you ever want to having trouble falling asleep one night, I would recommend it. I reckon it would put you to sleep in about 5 minutes.
In closing for this segment of this series, what would be two books that you'd recommend in the last 2 years that you for our audience? Because you sent me a really good reading list that was like a website. I plan on getting a whole bookshelf just for that reading list to put in
Yeah.
the living room. But yeah, just two ones that wouldn't be thought about. Example, like Richer, Wiser, Happier is one I've listened to a couple times. I thought was really exciting because it was like,
Do
I
you,
don't know,
do you mean
William Green. William Green. I like
Yeah,
him.
yeah, I know William Grant. I was listening to his podcast the other day with the guy Spear.
Yeah, I
And
enjoy both of them. We should go to
didn't he
the
do one with Chris Davis not long ago? He talks about Chris a lot.
Oh, I like Chris a lot. Yeah.
Yeah, Chris is a good bloke. Um, yeah, yeah,
Yeah,
very.
two books that,
Always, he always gives me the time of the day, so I can't complain.
I think
Um,
we should go to the Value X, by the way, in Switzerland.
in
Or
Switzerland.
or is it
When is it?
New Zealand?
No,
No,
I wouldn't be New Zealand. When is
Switzerland?
it, Jay?
Zurich. I don't know. It's invite only, so I guess we're putting it out to the world. We have to be invited. Yeah, so if you're listening to this and Guy or anybody, it would be
I'll try and get in touch with him. I know someone that knows someone that he likes. So
well, that's how it
hopefully,
starts. We got to get him on the
what
podcast.
he's very well mannered and yeah, he's pretty impressive. Yeah, yeah, but two books. What do you mean by that? Like, what do you mean by two books?
Not yeah, not
Do you mean like
folios.
investing books solely, or do you mean two business books?
Oh, anything that you'd say. Okay, two that the audience, maybe one that's a bit more sophisticated, one that's a bit more of a beginner.
I might have said it last podcast, but One Up on Wall Street by Peter Lynch.
Yeah, I like that book.
It's probably the best beginner's investment book out there. Um, it's hard, mate. I've read a lot of books, and there's good parts in most books. Um, I like Poor Charlie's Almanac because it talks about like it's more about life principles and all that. But that's a very mainstream answer, I feel. Um, I read The Intelligent Investor when I was 11. So imagine a dyslexic 11-year-old trying to read The Intelligent Investor. Um, I read the whole book through.
Wow.
There's two very good chapters in there. One of them's Mr. Market. I can't remember. I think it's chapter 11 or 13. I haven't read it since. I've definitely read other books. If you're a hardcore investor, I would read Securities Analysis. If it really depends what you're wanting, but yeah, I reckon Poor Charlie's Almanac and One Up on Wall Street by Peter Lynch. And if you're hardcore securities analysis, then there's like Capitalism, the Last Liberal Art, which is kind of similar to Poor Charlie's Almanac, and yeah.
Aleck, thank you for coming back to the Culture Matters podcast. If you're listening to this, please share this with a friend that you want to wake up to reality of what's out there, to learn and think about their future. And please leave us a review on the Culture Matters podcast, and we will see you next time on the Culture Matters podcast. Thanks, brother.
Cheers, mate. Thank you for having me on.